So now we are doing the practice of IFRS 15, and you have already seen the practice of IFRS 16 in your folder. You have done the questions of the right of use asset. You have done the question of sale and lease back. So you have done the question relevant to the IFRS 16. We'll be doing more questions in the next sessions, but today we are doing the practice of IFRS 15. And first of all, we have the question right in front of us. And this is the car soon question number 19 from the Kaplan kit, and the standard is IFRS 15. Now, the challenge is when you're doing the exam kit, in the exam kit, there are mixed questions. You cannot do the exam kit or practice from the exam kit unless and until you are done with all the standards. So for the students, it is pretty difficult to identify the question relevant to the standard. So what I have done is that this is my question bank right in front of you, where I have segregated the questions based on the standards, and I have actually accumulated the questions from two kits, the main two sources we have within the ACCA, which is the Kaplan and the BPP. So we will be doing the questions and the practice from this question bank first. And once we are done with the standard wise practice, then we'll move on to the past papers, which is the final thing we're going to do once we are done with all the standards. So this is the question cartoon, question number 19 from your Kaplan kit, and I'm going to read it for you and just try to find out what you are supposed to write within this question. Then I'll explain you once I ask from you that what you expect to write in this part from IFRS 15. You already know that this question is from IFRS 15. So just try to make the sense that what we are supposed to write within it. And then I'll show you from the slides that where this data has been covered within the slide and how you are supposed to write this thing within the exam. So the directors of the car soon wish to know how to account for the 15 million cost, the penalties, and the storage facility in accordance with IFRS 15 revenue from the contracts with customers. So this is the requirement. And first of all, we are just reading the requirement. So the directors need to know from you guys that how to account for the 15 million cost. Now, what is this 15 million cost? We'll see in the question. Basically, the penalties and the storage facility in accordance with IFRS 15. So make sure you just remember all the things we have discussed within IFRS 15. So Carson Company is a public limited company. It constructs premises for third parties. Okay, so their ordinary course of business is the construction. So they do the construction for other businesses, such as third parties. It has a year end of 28 February 20x7. Carson constructs retail vehicle outlets and enters into contracts with customers to construct buildings on their land. So basically, we know this is a construction company. So what they do is they do the construction for the other businesses on their land. So what they do is retail vehicle outlets. The contracts have standard terms. That means it's a standard drafted contract, which includes penalties payable by Carson if the contract is delayed. Now, do remember that where we have discussed this thing, we have discussed this thing within the standard. In the year ended 28th February 20x7. So for example, if the construction is not completed on time, the car soon has to pay to the company for which they are doing the construction. In the year ended 28th February 20x7, car soon incurred general and administrative cost of 10 million. And the costs relating to wasted materials of 5 million. So we have the general and administrative costs, and these have been recognized as the contract asset. Now, there was a slide within your IFRS 15 where we have discussed which costs to be capitalized and which costs to be expensed out or not to be capitalized. Hopefully remember that. Due to poor weather, one of the project was delayed. As a result, Carson faced contractual penalties. Carson felt that the penalties should be shown as a contingent liability Now we know that the contingent liability is, relevant to the IAS 37 thing. Although we have not done it yet, but you probably remember from your financial reporting exam that if the outflow is probable, then provision is recorded. If the outflow is possible, then the contingent liability is disclosed. Additionally, during the year, Carsoon agreed to construct a storage facility on the same customer's land for 7 million at a cost of 5 million. This was completed during the current financial year. So the directors of the Carsoon wish to know how to account for the 15 million cost, the penalties. So 15 million cost, that means which was the, now this 15 million cost is not the penalties. So this 15 million cost, is the general and administrative cost and the penalty. So they are separately asking for three things. They're asking for how to account for this 15 million cost, which is the cost incurred in general administrative overheads and the wasted material. This is the first thing they're asking you, how to account for this, whether it should be capitalized, and they have recorded this thing as an asset. So you need to comment on it, whether they have done it correctly. And the penalties. So basically the penalties they are supposed to pay to the business where they have delayed the construction. This is the second thing. And the storage facility, which they have constructed during the year for the customer land for 7 million at a cost of 5 million. So this is the third thing you need to tell how to account for these. So let me just ask first from you guys how this should be treated, and then I'll explain this. All right, so let's discuss the answer of this question. And so, like in this one question, in this one part, there are so many things which are being examined by the examiner from the IFRS 15. So first of all, they're talking about the cost of the contract. And we know there's a clear guidance within the IFRS 15 regarding the contract cost, which costs should be capitalized and which cost should be expensed out. So the cost that should be capitalized is simply the cost that is recoverable within the contract. Like for example, if you're spending an amount and that is recoverable, either specifically mentioned in the contract or that is represented within the price of the contract. Anything you are spending and you will get it recovered from the customer, whether it is being specifically mentioned within the contract or the contract price represent that thing within the contract price, that thing is included, then those costs should be capitalized. And anything other than that, for example, these general and administrative cost of 10 million should be expensed out unless and until it is specified within the contract that the customer will have to pay for this general and administrative cost as well. If that is mentioned within the contract, then you can capitalize it. But usually this is not mentioned. The customer is not supposed to pay you the general and administrative cost because this is a fixed cost of your business and the customer is not going to pay you that. Similarly, the wasted material is obviously your mistake. The customer is not going to oblige you for that 5 million. Unless and until that is mentioned within the contract. Like for example, if the customer agrees, okay, like for example, you're doing something difficult and the customer agrees, okay, I'll be paying for the wastage as well, then that is a different case. But usually no one pays for the wastage because that is your fault and that is your incompetence that there are wastages being incurred. So this 15 million, 10 million plus 5 million is going to be expensed out. So they have recognized this thing as a contract asset. So they need to remove it from their books. So what they're going to do is they should credit the contract asset, which they have capitalized, and debit should go to the profit or loss. And make sure either you mention this double entry in the form of the words, for example, narration, or you just write the journal entry itself, debit and credit. That is going to create a very good impression. So this is the first part. So you start by writing that according to IFRS 15, certain contract costs which are to be recovered from the contract should be capitalized. Either they are specifically mentioned or the contract price is representing that. Any other cost, such as general and administrative costs, wastages, should be expensed out unless and until customer specifically agrees to pay that as well. So clearly this 15 million, 10 plus 5 million should be expensed out. They have performed the incorrect treatment. They should do the following journal entry: credit, contract asset, debit, profit, or loss. So this is how you are going to write it. And then we have the second thing. So, okay, so see, so we are done with the first part. Now we have the second thing. Due to poor weather, one of the project was delayed, and as a result, Carsoon faced contractual penalties. And we have discussed this contractual penalties thing within the slides in the variable consideration. So like, for example, if I'm supposed to get 100 million from the contract, let's assume, and the 10 million is for the penalties if I'm not doing the work on time, and it is highly likely that I have to pay the penalties. So what you're going to do, the treatment described by the IFRS 15 regarding this variable consideration is that if it is highly likely, if it is probable that the business is supposed to pay the penalties, then you are supposed to deduct this penalty amount from your consideration, and you are going to record the net amount as the revenue when the performance obligation is satisfied. So remember this thing, that if the penalties are highly likely to be paid, then this is a variable consideration thing. Variable consideration means that your consideration is variable, dependent on your certain matters. So here the certain matter is the timely completion of the contract. So if the business believes that it is highly likely that they will not be getting the complete revenue and the 10 million will be deducted by its client as a penalty, then you're going to record this thing as a deduction from the transaction price. And accordingly, when you meet this performance obligation, satisfy the performance obligation, you're going to record the net amount. So this is the treatment of the second part, that IFRS 15 describes this penalty situation as a variable consideration. And if it is highly likely that the business needs to pay the penalties, then what they're going to do is they should deduct the penalty amount from the transaction price, because that is related to the significant reversal of the revenue. That, for example, if you record full thing and later on you need to reverse the revenue, so IFRS 15 says that if there is a probability that you're going to reverse the revenue later, so do it now. Deduct the price from the transaction price. Deduct the penalty from the transaction price. So this is the second treatment. And this is one of the most important standard of the exam, this IFRS 15. Now coming towards the third thing, which is the storage facility. So it says additionally, now look at the wordings, how beautiful examiner is setting these wordings just to make sure you pick up the relevant thing which is supposed to be written in the answer. So additionally, during the year, Carsoon agreed to construct a storage facility for the same customers. So same customer means that it is actually a series of contract going on with the same customer. And hopefully you remember that distinct feature of the contract. Who remember that? That when the contract is this distinct performance obligation, when the contract is a distinct performance obligation and recorded as a separate contract. So there was a clear guidance, and I have clearly explained it when I was doing the IFRS 15, that it is possible that you're doing a series of exercises with the same client, So if you're doing something distinct, if you're doing something additionally, then that should be recorded as a separate contract. So here, additionally, during the year, Carsoon agreed to construct a storage facility on the same customer's land for 7 million at a cost of 5 million. So this is a separate performance obligation. This is a distinct performance obligation. This is an additional contract that the business is having. So when they have, so it was written, this was completed during the current financial year as their performance obligation has been satisfied. So they should record the revenue regarding this contract because this is a distinct performance obligation and it is not connected with any previous thing. If it is connected, then obviously that means you cannot record it, but it is a separate contract. It's related to the separate storage facility which needs to be constructed uh, for the client. So that means it should be recorded as the revenue. So this complete question was for 7 marks. So this is the exam style question, an exam question, and this type of questions you will be having in the exam. So make sure you remember all the stuff which you have studied within that particular standard. So look, 3 things they have tested from this standard. The first one was the contract cost. I'm going to show you this from the slide in a while. The second one was the variable consideration, and the third one was the distinct performance obligation. All right, now let me show you where we have studied these things within the slide. Okay, so we started with this thing. The first step, identify the contract. And this was the combination of the contracts. When the contract needs to be combined, and that was 2 or more contracts that are entered into and at the same time and with the same customer are accounted for as a single contract if they are dealt as a negotiation. For example, price of one affects the price of other. So this was when you are supposed to combine the separate exercises as one contract. And this was the contract modification. A contract modification is accounted for as a separate contract only if the scope of the contract changes due to the addition of the promised goods, the price of the contract increases by an amount of the consideration that reflects the vendor's standalone selling price. If you're doing something that is an additional work, and whatever you are charging is a standalone price, what you usually charge if you're doing only that particular task. If you are charging that price, then that means it's a separate contract. So when a contract modification is not accounted for as a separate contract, the vendor identifies the goods or services that have not yet been transferred. So if you're not dealing this as an additional contract, then it is related to the previous one. Otherwise, it's a separate contract. So this, if you remember these lines as it is, as the standard says, and you just copy paste this thing in the exam, examiner is going to give you the full marks. So this was a very important thing, the contract modification. So you need to watch the video of the standard, understand it, and then read it yourself as well. So this was the contract modification, and this is the distinct goods and services thing. At the inception of the contract, the supplier must identify each promise to transfer distinct goods and services. So this we have already done. So this was the first thing. And see, this is the variable consideration. And these are the lines which you are supposed to write in this question, which we have done. IFRS 15 says that this estimate can only be included in the transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. This is as it is, the standard says. Like, for example, if there are any penalties, look, this is written over here. Variable consideration can arise for a wide range of reasons, including discounts, rebates, refund credits, price concession incentives, performance bonuses, penalties. So just make sure you are reading each and everything of the standard, because examiner can ask you anything. So this is what we have discussed in the variable consideration regarding the penalties. And then there was a last thing. Let me just show you the contract cost. This is here. IFRS 15 says that the following cost must be capitalized: the cost of obtaining the contract, the cost of fulfilling the contract. So this is, and what is written over here, I've already told you, and the entity expects them to be recovered. This is the important point over here. Whatever you are spending on that contract, if that is recoverable from the customer, either specifically mentioned, for example, you've given the breakdown to the customer that, okay, you have to pay for this and pay for that, or your transaction price covers those things, then that means you are supposed to capitalize all those costs. Otherwise, that is going to be expensed out.